Good afternoon, everybody. Today is Friday, the 24th of January, 2014, and this is Brian Shannon speaking from Alphatrends.net. Let's take a look at these markets. We had the S&P 500 lose 2.5%. 2% of that was today. S&P 5, the NASDAQ down 1.3%. Russell down 2%. So all of our equity indexes are negative year to date right now, and we have last year's losers, such as gold and bonds, actually leading the way here with 5+% gains. So let's take a look here at the action and dissect the charts. The S&P 500 gapped lower, obviously, on Thursday. We had a 4-day week. This is the volume-weighted average price for the week, up at about 182, and here we are at 178.80. But we gapped lower on Thursday, and at Alphatrends, we got stopped out of some profitable long positions, as well as a couple small losses, and then didn't get back involved in any longs. So we safely avoided this pullback, and we had a few scalps on the short side. But as I say each week in my emails, what I ask myself at the end of each day for subscribers is, one, did I help people make money? At the beginning of the week we did, and secondly, did I help them avoid losing money? And I think that by sidestepping this, absolutely the answer is yes to that. No one catches all of these turns, and it's easy to look at and say, wow, I should have been super short or something like that, but only liars catch all of these turns like this. And what we want to do is what we've always done is, when the market breaks down below a key level of support and is below a declining 5-day moving average, that tells me no overnight trades on the long side, and that we wait for evidence that the buyers are regaining control before we re-enter. It doesn't necessarily mean get aggressively short, because the primary trend has been higher, and up until today, obviously, we were holding a key level of support, this prior resistance, which was last week's low as well, and we were holding above that 50-day moving average. That's the green one tucked in there. Thursday, we did lose this trend line that came off of the October lows, and if we measure Fibonacci, let me just clear that off there. If we measure Fibonacci off of these October lows, then a 38.2% retracement would bring us down towards this 177 level, which was the low there late in December, that intraday low in December. Actually, it was the December low. So it's possible we could still see a bigger flush in this market, down perhaps to that Fibonacci level. We're holding right now at this trend line. It kind of represents the essence of trend here over the last several weeks. Several months. And right now, I think that the prudent course of action is to let this market settle in, see where it wants to find some support, and we want to look at what are the potential levels of support, and that would be down at about 178 or so right now, as this prior important level, as I said, was broken on that gap today, and really signaled that there were bigger problems for this market. Now, next week we have a lot of earnings still coming out. Of course, Apple is on Monday. We have the employment report on Friday, and there's a lot of catalysts in this market that could potentially move it higher or lower. But what we want to look at as now is that this market is guilty till proven innocent in the intermediate term, as long as we're below the declining 5-day moving average, and that we have the market below about this 182 level. There will be day trade opportunities for the long side, and some people will be able to pick the exact bottom turning point. I think it'll be more a case of dumb luck if they catch it, because certainly nobody caught any turning point in here today for anything more than any scalps. There's always opportunities, of course, to make money on the long side, but when we're in a declining mode with the market below the volume-weighted average price like this today, then you can look for potential levels of support, but you want to wait for the actual evidence that the buyers are coming in, and really today that evidence certainly didn't exist. And again, we're guilty till proven innocent going into next week. Now, the NASDAQ remains above its rising 50-day moving average here. That's that green line, as well as this trend line that I've drawn in that has kind of represented the essence of trend since mid-November. Now, if we wanted to take some Fibonacci off of here, we would go to what I think is the most relevant higher low, and that would be down at this point here from October. And right now, I don't think that those are important enough levels to look at. That we're more likely, I think, to find some support and bounce perhaps down near this level, near about 85.60, that could be a potential level of support. But again, it makes no sense to be blind guessing in here, trying to buy. I mean, even back over here when we broke below that 5-day moving average and it got back above it, we had time to participate on the upside. Don't be in such a hurry to get involved. Let the selling, kind of bleed out a little bit and wait for the evidence that the buyers are actually there. And if you're going to be trying to pick a bottom, then do so with the mentality that you're looking for a day trade opportunity. And if that day trade opportunity turns into something bigger, then perhaps that's something that is worth holding for a longer period of time. But right now, the evidence, again, just isn't there. So we have this trend line that I had represented on the daily chart, which is also, I don't know what, which I had represented on the daily chart, and that's about where we have that 50-day moving average as well. So I think that the potential band of support in here is probably about $85.75 to $86. And we'll see what the market gives us. But right now we want to look at it in terms of this band of support that we were monitoring this week was decisively broken. Now, when we do get a bounce, the question is, will this area become resistance and then turn this market into something more significant in terms of the potential for downside? The Russell 2000 was down, what do we have percentage this week? Down 2.1%. So even percentage-wise, it's not that bad, but there was a lot of damage done to individual stocks, and it's going to take at least time to recover. The Russell 2000 is actually at a pretty important level here at about this 113.5-ish area. You can see we have the rising 50-day moving average, that green line in there, which often acts as support, but not to the exact penny as some people would like it to be. But we are testing that 50-day moving average again, as well as this trend line from actually from September of last year. So if we were to draw Fibonacci on here, we would look at that most important low, and that would get us down to about 111. And again, just as I said in the NASDAQ rather, I think it's too far away to really have much bearing on what we do here in the intermediate term. We're at an important level here for the Russell 2000. This seems like an area that should be support, but there's no evidence of it yet. Only that the bell saved it basically from going any further, declining any further. One scenario for next week, potential scenario for next week in these markets is maybe we get a gap up on Friday and then we sell off again and then kind of hammer away at this support in this 113.25 area. If that happens, then we would look to the daily time frame and say, well, what would be the next potential level? What are the bigger levels below this area? And it's not really a good thing to look at because there's really not a lot. I guess that this level right here maybe where we had this resistance kind of become support and then pivotal in here. So maybe down at about 112. The fact is no one's going to be able to tell you exactly where the market will turn, when the market will turn, but we want to say at least as a minimum we want to avoid buying even from day trading purposes as long as we're below the volume weighted average price for the day. From an intermediate term perspective, as long as we're below the declining 5-day moving average, we want to avoid buying for any swing trades. And now we talk about the 50-day moving average, that it's still rising and the market's innocent till proven guilty, which I believe is true. We're still in a primary uptrend. However, as with any time we get a serious correction, it turns us more neutral in the intermediate term, actually guilty till proven innocent, but more neutral on the overall bias from that longer term perspective until the market can prove that it is actually going to find support once again. Again, we're not trying to pick the turning points. We're trying to get involved and participate in parts of the trends. The semiconductors still have this important trend line below at about 41.25, but we're really at a level that's been pretty pivotal here for the last month or so at about that 41.5 level. So for now, we're holding above that 41.5 level. It's been important for the last couple weeks, and we were hoping actually that this prior resistance, which held as support earlier in the week, was going to hold once again. But obviously, the market had other ideas, and hope isn't a trading strategy. What we have to do is always be prepared for any possible scenarios and be aware of things such as what is the direction of the 5-day moving average? Do the odds favor that a bounce like we saw Thursday afternoon will be able to continue to follow through on Friday? And obviously, the answer is no. Sometimes you get you get the gap up and it continues to run. But right now, we're in a environment where we had today the breadth was 2,600 declining, 2,676 stocks declining, and just 399 advancers today. So it's not when you look at the advanced decline line and it stays weak like that, I've got people asking me, hey, does this stock look like a buy or does that stock look like a buy? And the answer is no. Let's let these stocks settle up. Let's settle down rather, and let the market bleed out a little bit, and then tell us when the proper time to buy is. But when there's 7 stocks up for every one, 7 decliners for every one advancer, then the odds just don't favor buying, and it astounds me that people continue to try to buy stocks when we have this much damage and that the majority of stocks are heading lower. The financials really got hit harder this week, and you can see here they broke this trend line off of the October lows, and taking a look at Fibonacci in here for potential retracement levels going off of this low up to the highs that we saw this year. You can see we're right down to that 38.2% retracement, and we're also at what's been an important level of support in the fourth quarter of last year, that this 21 level has been important. And I would say that if we saw further selling in the financials, I would expect that a bounce would in fact materialize somewhere within this area, this 38.2 to 50% retracement, not just because of Fibonacci, but because we had this as a prior significant level of resistance that had finally broken out and led to a nice continued rally higher. However, we do have that broken trend line. We are below the 50-day moving average, and I would expect a bounce though at some point because the 50-day moving average is still rising. However, the evidence isn't there right now that says it's in a place where it is bouncing. This is a potential level of support. If you're the type of person that buys on pullbacks into perceived levels of support, I hope it does in fact work for you. It's my belief that you're better off sitting on the sidelines in cash waiting for the actual evidence to occur, and at a minimum to be above a volume weighted average price for that bounce trade, and that the volume weighted average price is flat to advancing. Then we go on to tackle, well, where there's a potential resistance for that bounce trade, and the 5-day moving average always is a level where we would expect resistance to be found when it's declining, and we have this bigger prior area of support. This was a significant level that was broken today, and we can see that this is likely to become a band of resistance when in this market, and if it bounces back up and towards that level. So there will be some bounce opportunities coming. Maybe the catalyst will be earnings. Maybe the catalyst will be something the Fed says. We just simply don't know. So rather than try to guess what's going to happen, the job is to wait patiently. You can't sell short down here. My opinion is it's too close to support. Now maybe it continues to decline into $20.90. If it continues to decline, I have no problem missing that decline. I'm not looking to short that. What I would rather do is wait on the sidelines, because it looks to me like we've sold off pretty hard here, and there's a greater potential for a bounce scenario somewhere. As I always point out, I don't really like gold, mainly because it's in a downtrend. We've been talking for over a year about this retracement level on the weekly time frame, and you can see that we've come down to that 61.8% retracement, very close to it, and we're still though in a downtrend. If you look at the longer term moving averages, they're still heading lower. We've got the 50, the 100, the 150, and the 200 all in decline, and it reminds me of the phrase that if they don't scare you out, they'll often wear you out. The market has, the gold that is, has staged an impressive rally this year. We do still have the major moving averages declining, and I think it's likely in the pretty near term that this market will find resistance and turn back lower. So Again, I think there'll be better times to buy gold. It's still in a primary downtrend. Bonds really had a good week as well. They're still in a primary downtrend, and I've been talking about the Head and Shoulders target, which would have given us down to about 97. Now, obviously, this market has had a nice turn this year so far. It's broken some resistance, and this is why, even with a declining 50-day moving average, I don't want to sell short bonds, not while it's above a rising 5-day moving average. And look how this market has held that 5-day moving average. So if you're bearish on bonds because of the longer term outlook, you can see it's coming right up towards that declining 200-day moving average. You don't sell short as it's rallying. Instead, what you want to wait for is for a pattern of lower highs and lower lows below a declining 5-day moving average, and that's obviously not the time to do it now in these bonds or in gold for that matter, which is rallying here and showing a pattern of higher highs and higher lows. The shares of Apple report earnings on Monday, so there's going to be, obviously, there's the catalyst there. The catalyst this week, when Carl Icahn started talking about it, failed to hold this market, Apple up, that is, and that was, I believe, it was on Thursday. So it was Wednesday when he started talking, and it sold off that day. Tried to recover on Thursday, but you can see that Apple really is just kind of non-directional in here. We have this bigger level of prior resistance that the market's trying to hold support, and then we have this level here at about 556, 557 that's been resistance. Looking at the daily time frame, it's pretty indecisive in here as well, I'd say. We've got these higher lows, and we have this flat area of resistance. The earnings are going to be a gamble. I have no interest in trading Apple in front of earnings. So, the good news, I suppose, is that the longer term trend is still higher. News and surprises tend to follow the direction of the trend. If you're betting on earnings, I hope that you get it right at whatever direction it is. If you're looking for a strategy that is based on market structure and in a consistent approach, regardless of what the market condition is, then go ahead and take a 7-day trial to Alphatrends. I promise I'm going to help you learn more about the market. I'm going to help you avoid big down days and bad stocks that are in downtrends. I'll keep you out of a lot of trouble, and more importantly, I'm going to help you make money and educate you. Thanks for tuning in. Have a great weekend.